And good morning. The doctors are in. Welcome to QuickDraw Fund Control's live webinar. I am Greg Norris. I'm the principal president and chief doctor of QuickDraw Fund Control Hospital. And I was working on a patient earlier today trying to prescribe something, and this is how they turned out. So you're in for a bumpy ride here. So we've got a great team of panelists here. It's my pleasure to not only work with them, but have known them for years. And I'm going to introduce them as follows. Due to some technical difficulties, you won't see Brenda Bishak, but she is on the webinar with us. And Brenda is the principal and founder of BLB Ventures. Brenda has a significant history of home building, and BLB Ventures was founded back in 2012. Brenda provides both project management and purchasing for developers throughout California and the Western region of the United States. She also builds for her own portfolio, both renovation and ground up construction. And I've known Brenda back since the 1990s when she was actually a client of mine. So it's a real treat to have Brenda here and hear what she has to say with her work experience. Next on the list, we've got Mr. Daniel Limon, who is the Senior Vice President of Citizens Business Bank, heads up their real estate group. Daniel and I have the good fortune of going back to the community bank days. And when Community Bank was purchased by Citizens Business Bank a handful of years ago, they were smart enough to elevate Daniel into his current position. And he runs a great group and a great team with projects throughout California as well. And last but not least, Mr. Scott Taylor, who is the founding principal and CEO of Artes Capital. Artes Capital is a private REIT, newly formed within the past year, off to a smoking start. And Scott and his team are working also throughout not only California, but the Western region of the United States, providing both bridge and construction lending to their clients. So welcome everybody. Thank you so much for coming in today and being being a panelist and talking about really the health of the market. As the title of our webinar, the doctors are in. We're just in kind of uncharted waters yet once again. Everybody agree with that?
Yeah, no, thank you, Greg, first of all, for putting this all together. And yeah, I would agree. Here we are in the middle of a second wave of the pandemic, but the real estate market in general seems to be doing very well. Rents on multifamily are up. Single family home prices are at all-time record highs. I think this is the busiest I've been in the lending industry in 2 decades, which is great, but it's also a little concerning. Is there too much euphoria in the market and not enough analyzing of risk? That's always something, as a lender and a former banker myself, is always watching closely. So looking forward to our discussion today.
Yeah, thanks. Daniel, what are your initial thoughts of the market today?
I agree with Scott. It is a pretty hot market right now. There's a lot of activity going on. As a lender, we're by nature a little more conservative, a little more, we got to analyze things sometimes from all different scenarios. But we're seeing some significant kind of price increases in the housing market. It's forced people to kind of be out of that space to buy because of the competition. So now they're forced to rent. So as a result, we're seeing rent increases going up as well. So, it's a combination of a lot of factors. You're seeing low interest rate environment, lack of supply, all those things kind of contribute to, what Scott alluded to is this euphoria. Is this sustainable to have those kind of increases? And the fact that COVID has brought sort of a significant shift in how we operate day to day. You look at the online purchases and what it's doing to the industrial market, now with a significant demand for, distribution space, warehousing, logistics, all that's putting a lot of, fundamental strength into the industrial market as well. So some really, really bright spots that we see here. It's
Mhm.
just, how long can it continue and go this path, especially with some of the concerns regarding inflation and potential rate increases in the future.
Yeah,
So we're being cautiously optimistic.
that's a good approach. And Brenda, in your business, I can't imagine it's nothing less than crazy busy. Is that an accurate statement?
That is true. And I don't believe I've ever spent quite so much time putting out fires in my entire career, just because there is a constant daily shortage of everything, from manpower to material. It's insane. I've never dealt with so many scenarios where I have signed contracts from vendors and confirmed, delivery and installation dates that, all of a sudden become, I'm supposed to be out there putting the garage door in on September 18th. And now I'm being told that the door is not even going to ship until November 10th. I mean, it's like you used to worry about somebody coming in and stealing appliances or, air conditioning condensers. And now if you've got a garage door, it's like gold and you have to have a security guard on the site. So it's
Wow.
really, really challenging.
So let's talk a little bit about the health of the supply chain. I think we've all known that as a result of the 2008 Great Recession, there was a mass exodus of labor that left the industry for good. And as the market started to recover a handful of years later, the labor market was only grown organically by the subcontractor base. I mean, the unions were pretty much out of the picture, and that legacy was gone. So as the market continued to gain strength, it always outpaced the amount of skilled labor in the market. And that fight continues. But what is new to our industry, and as Brenda was talking about, is now the health and challenges of the supply chain. It's not just limited to construction. We're seeing it with daily household items. And the price increases that, in talking with friends in the industry, they're coming fast and furious, weekly. Resin-based products right now is a hot topic. We all know lumber has come down, but a good friend of mine who runs a large plumbing contractor said both the waste and iron pipe that they're installing in the plumbing systems, they're getting 18% increases, and on top of it, they're having to buy everything they possibly can because of the lead times. So,
Yeah, it's crazy. It's
yeah.
crazy. It's PVC based things. We're so ecstatic because lumber had come down, and I tell them, well, relax, because steel's up, PVC's up. You can't get a condenser. You can't get a refrigerator. You can't get a garage door. I have labor being hired off of job sites, like at an incredible rate, a lot of poaching going on. So, I mean, lumber is the least of it at this point for sure. And besides, lumber ticked up a little bit last week. So I don't know if this low number is really going to hold for much longer.
Brenda, how does this translate to the construction schedules, where you previously had, say, a 15 or 18-month build cycle? How much time is this supply chain interruption adding to the time it takes to build a project?
Well, it's definitely made an impact. And I think the most frustrating part is that it's really difficult to forecast and to accurately build in any kind of days to your construction schedules for these delays, because they seem to happen so unexpectedly and at the last minute. So it's really difficult to juggle what's going to hit you that day and what's going to impact your schedule. And maybe you can't get that item on this phase, but on the next phase, it'll be fine. But there's some 2 or 3 other things that aren't going to show up, or 2 or 3 other crews that aren't going to show up. And it's really difficult to forecast. That's the problem, because we're seeing no shows and extended lead times and delays on products that we've never seen it on before. So, there's no real accurate way to build that into your schedule. Plus, it's a moving target. It's like you'll hear, I'm not going to be able to get your refrigerator for 3 weeks after it was supposed to be installed, and then the day before it's supposed to be installed, then you get the call like, no, it's going to be another 4 weeks. So it's just it's such a fluid situation, and it's so unexpected and unprecedented. It's just really difficult to forecast it on any level.
Yeah, and then to compound that, you're having the delays of the supply chain, and then to get inspectors for the municipalities out with delays and schedule changes, or the utility companies and getting them to come out and perform work. I mean, it's just like a double whammy to the developers right now. And that additional carrying costs, I mean, we're seeing deals go 6 to 9 months longer than expected. And the carrying cost comes right out of their profit. Now, the good news is if they're in the right vertical, if they're in single family homes, if they're in industrial, if they're in, some of these product types, multifamily, we're starting to see rents come up. If you're in those verticals, the values of the properties are also rising. And some are even saying, some of our home builders are saying that the increased costs and the increased carry, they're actually doing even better when they sell the home. So they're making more money, but how long does that last, right? The costs are real. The value is based for the most part on kind of consumer sentiment and low interest rates and all these other things that are unprecedented. So, you get concerned about underwriting to these increased values and are they going to last? Because the costs don't look like they're going down. The other quick thing I wanted to mention was we saw a lot of people in March of 2020 significantly reduce staff, not sure what the pandemic was going to be, and they slashed workers. They did all these, measures to try to protect cash and cash flow. Those people got hurt really badly when 90 days later, kind of everything started going again. And the clients and the companies and the developers who actually took care of their team during those very unprecedented times are actually thriving today because they didn't lose their staff. They're not trying to go out and hire new people. And that's something that I think we should all take away of, human capital is the most important part of any of our businesses. And when you take care of your team, it usually pays off. And if you don't, you pay the price for it down the road. So that's been an interesting thing to see how different borrowers and developers treated their own teams and their own subs. The people that took care of people they still have labor. The people that didn't are struggling to find it.
Yeah. Daniel, how's your book of business and what are you seeing with your clients?
Yeah, our book of business is pretty strong. We're doing about, 50% residential, 50% commercial. And just to highlight on the topic we were just talking about, the supply chain pushing out, especially on the for sale, housing side, we're seeing our, developers having to get creative. They're having, buyer retention parties. They're adding in additional rate lock extensions on their loans. Which are fortunately pretty inexpensive right now. So, normally you would have a 60 to 90-day lock, and they're, possibly going out to 6 months now to deal with these potential delays in delivery. So, I think Brenda alluded a little bit earlier, we're working a lot harder today to kind of achieve the same kind of results we did pre-pandemic. And so whether it's a supply constraint or whether it's a labor issue, there's a lot more oversight that needs to go into this, and almost thinking on your feet to make sure you can get from point A to point B. And so, it becomes challenging to manage not only from a development perspective, but from a lending perspective, where are my cost overruns happening? And am I on top of them? Because, you will see often developers try to say, I'm having cost savings in this area. They're really just trying to move money around to cover those increases, or, they're running out of contingency sooner than later. So it definitely has become a challenge for us to manage it both on the developer side and on the lender side as well.
Yeah.
Yeah, that's well said, Daniel. Just to interject really quickly. About 2 years ago, we increased our standard contingency on all of our construction and rehab projects from 5% to 10%. And I can't tell you how many times our clients, complained and, oh, I'll never need this. We do not have one deal that we've done in the last 2 years where they haven't used their full 10% contingency to get through to the end of the day. And by the way, and above and beyond that, they're having to come up with new capital to right size the budget. And to plug, Greg and Toby and the QuickDraw team, they are the reason that we're so on top of that stuff. We use them exclusively for our fund control and inspections. And they're out there making sure that none of that stuff is happening and you're not robbing Peter to pay Paul on another project and all that stuff, so we can manage our risk appropriately. But it's the last couple of years have been really challenging on the construction lending side, and making sure that there's sufficient capital to finish the project and get to C of O, which continues to get pushed out and delayed. So it's the reason why you do business with well-heeled developers that can get you to the finish line.
Thanks for the kind words, Scott. Hey, Brenda, let's talk about building cost per square foot for a minute. Go back a year ago when the pandemic hit, or just maybe even pre-pandemic. On a typical single family home, were we about 75, 80 bucks a foot?
I would say about 80 bucks a foot, yeah.
Okay, and then take us through 2020 and where we are into 2021.
Well, I mean, if you just want to make an equal point of comparison on a single family, I would say I'm up about $5 or $6 a foot on directs. And that doesn't take into consideration the horizontal, which has also, it doesn't get a lot of lip service, but just by virtue of a lot of the PVC products has really taken a hit as well. I'm shocked when I see the numbers going up as they are on the wet utilities, for example, and on the dry utilities. But in terms of house costs, and taking, to his point, taking the carry cost out of it, just the direct impact has been, a good $5 a foot. And that's sort of taking lumber out of the equation. So I've had a single family project in Corona that I've been, tracking for about a year from our initial budget to where we are now on our going to contract budget. And even though we bought lumber when it bottomed, I'm still at $5 a foot, and I'm happy it's only that. And again, have cautioned my client that he needs to take into consideration all of the delays that we ought to just anticipate in his schedule and make sure that he's got that all covered in his schedule and his carry costs and whatnot. I mean, as everyone said, due to the euphoria about the market, when these price increase posts, most of my clients have been saying, well, that's okay because I'm getting, my sell price is up 20% from where I pro forma this thing. But at some point that well's going to run dry. I kind of feel like it's pretty maxed out now, and they're not going to be able to compensate for all of these overages in both cost and time.
Brenda, thank you. Excuse me. Thank you. That's really good information. How's the bidding process right now? Is it hard to get subs to bid?
Yes. In a word, yes. It's a lot more difficult to get them to come to projects that are off the beaten path. I have one client who builds in the South Bay quite a bit, and that's a very challenging market to get subcontractors to want to go to because the travel time for their guys, where they're coming out of, and the traffic they're going to have to deal with. So they're very choosy about location. And also some of my smaller projects where I traditionally haven't really had a problem getting people to bid, really challenging to get someone who even wants to take a look at something, 10, 12, 15 units, just because they're so busy and they're going to have to pull their workforce and put them on a smaller project. So it's been challenging, depending on logistics and the size of the project. Like the 23 single families in Corona, all my guys want that job. And it's sort of becoming contingent upon, well, if you want that job, you have to do the 8 in Culver City too, or you're not getting it. So,
Yeah.
you know, I've kind of started using like the sort of big, fat, easy jobs as leverage for some of the more difficult infill, which is a big percentage of my portfolio. There's most of what I'm doing right now is, you know, urban infill, and it's difficult for the trades to get there.
Yeah, and wow, that's really really great strategy and very
Oh, I'm
smart.
full of them.
Hire Brenda.
For sure. Hey, Brenda, because I know you know you got a hard stop at 11, but what kind of price protection, if any, are the suppliers and subcontractors willing to offer today?
It's non-existent. It's non-existent. I mean, I'm getting bids that literally say on them, this price is good through Saturday. I mean, this price is good for 48 hours. I cannot tell you how many trades I have who have signed contracts that just come back to me and say, can't do it, won't do it. Under no circumstances can we operate at this cost now. And I mean, I suppose I don't want to name names, but what the hell, I'm just going to do it. True Team, who is a, you know, a very large builder subcontractor who supplies multiple trades, insulation, garage doors, gutters, fireplaces, have not honored one contract that I have with them in the last 90 days, and have flat out no-showed if they don't get their price increase, shut my jobs down and just say, we can't do it for that number. And we're not coming until you give us the increase, and we don't care if we have a signed contract.
Wow.
Yeah. And it happens all day long.
How do you mitigate that? Because they're not, you know, 3 other True Teams behind them.
I have a really big bottle of tequila in the freezer, and that makes the evening a little bit better.
Yeah.
But it is true. And you know what's so interesting about, just you know, not to beat True Team to death, but they have been pretty much the worst offender. They own Wayne Dalton Garage Doors, and you literally have to order your garage door before you drop lumber, and you're still probably going to have to wait another 60 days to get it after the date that you schedule it. So even though they own and control a lot of the products that they install, I actually have like kind of smaller garage door guys that can get me a garage door a lot faster than True Team can, even though they own Wayne Dalton, which is like the biggest garage door company. They're the ones falling apart on every single one of my jobs. I'm seriously looking at more than a 60-day delay on setting garage. And, you know, as you know, it sounds like a stupid thing, but how do you secure your job without a garage door? So you're having to do like board ups to secure your houses because you can't get a garage door.
Wow. All right, so this paints quite the picture, everybody. So we've got, you know, interest rates that are low and favorable. We've got inflation that's looks like it's here to stay, at least for the short term. We've got a Delta variant. We've got, you know, a finite labor pool. We've got a supply chain that is unpredictable. We've got a, you know, high demand in the market. How does this translate to your business strategies? Is it just really sticking with the fundamentals? Are you thinking outside the box? How do you navigate this from a lender perspective? Daniel, you want to weigh in?
Yeah, I mean, you know, everything Brenda just talked about is one of the primary reasons why, you know, experience is one of our top priorities in how we underwrite our projects. So we want developers that are extremely experienced in doing this type of development. They're the ones that have, you know, the contacts, they have the way to, you know, manage these challenges. And so that is something that we're looking for. And if they don't have that, it's probably something we're not doing as a lender. So experience and track record is something that's, you know, extremely important. Obviously, as a lender, we're looking for, you know, the ability to handle cost overruns, you know, if they're burning through contingency, the ability to put in the additional capital if necessary. And so those are the two primary areas that, you know, to the best that a lender can do to try to secure these challenges. But the fundamentals are still fairly strong in terms of, the economy's still doing very well. There are a lot of people working. In fact, we have more challenges in hiring people than we have, in terms of actually having jobs that are available. And so, once I think some of these jobs start to get filled, you're going to see some of those fundamentals improve, and hopefully it will help things kind of calm down a bit. But you're right, we got to be, like I said, cautiously optimistic, and so that's how we're trying to manage it going forward.
Daniel, two questions. Are you entertaining new customers, number one? And number two, are you projected to grow your unit this year?
Yes. So, and that's a common theme you're seeing across, stock market. I mean, investors are looking for growth. And so you need to be able to show how you're going to grow your business. And so we are looking for deals. Obviously, we're looking for quality deals.
Mm-hmm.
If you look at any bank situation, their liquidity is pretty much through the roof. That, deposits are higher than they've ever been. And so we as an organization, like other banks, have a lot of money that's just sitting there, at the Federal Reserve earning 10 basis points. And so we would absolutely love to put that money to work with quality loans, but it's competitive. There's a lot of capital chasing smaller deals. All of these things we're talking about, like supply chain cost increases and municipality delays, that just makes less projects available because things are taking so long to come, to be ready, shovel ready. So, a lot of challenges, but this is how we try to deal with it in an environment like this. So,
yeah. What do you think, Scott?
Yeah, I think, our main focus for Artez is relationships. 85% of all of our deals are with repeat sponsors that we've been doing business with for years and years. And so that initial underwrite of the client, understanding their financial strength, their recurring cash flow from other properties or businesses, understanding their liquidity positions, their overall leverage, is critical to us. And even though we're a private lender, my background was Wells Fargo, we're still underwriting these clients to make sure that they're bank qualified. A lot of clients will work with us more for timing, not necessarily due to cost or the quality of the project. Bankers are always shocked when they look at our portfolio and see the types of loans that we're doing, and we're able to charge a premium on the rate and fees. But the deals are quality, and the sponsors are very well-heeled, strong sponsors, and so that will continue to be our focus. We are not interested in doing business with inexperienced people. We're not interested in doing business with folks that don't have the financial wherewithal to, as we call it, staying power. You don't lose money in real estate if you don't have to sell when the market goes down. As long as you can ride through that downturn, you'll come out fine on the other side. It's happened over and over and over again. And so we always want to make sure our clients have the ability, to get through whatever might happen. One of the interesting things that we haven't spoken about yet is kind of this eviction moratorium. And there's still a lot of commercial landlords that aren't charging full rent to their tenants because they'd rather get 50% than have it empty. And there's some pain coming. And by the way, there's parts of the market that aren't doing well. Hospitality has jumped back, but man, a year ago, revenues in hospitality literally went to zero.
Yeah.
There was
Scott,
nothing.
I'm going to ask you to hold that thought because I do want to come back to it, but Brenda's got a hard stop here. And Brenda, last thing for you, what advice would you give builders and developers today that are not using you, and how to proceed in this kind of a environment successfully?
Well, I don't know. I don't like being in a reactive mode, which is how I feel like we all are right now. That we're just getting caught flat-footed by so much of what's going on and the volatility in the supply chain and the labor market. The one thing that I'm always trying to impress upon my superintendents in particular is think ahead. Think ahead, anticipate what you can, anticipate what you can't, because sure enough, something's going to come up that you've never run into before that's a problem today that we haven't had a problem with before. You can't schedule out soon enough. You cannot check in frequently enough with the trades or the utility companies. Nobody's word is good. So you have to assume that they're not going to hit their mark. They're not going to hit their date. And all you can do is be as proactive as you can. Try and put out the fires as they come up and anticipate what you can, and always try and have a plan B to keep the job running. Because otherwise, if you have to bump a guy for a problem that you're having, you're going to end up getting to the end of the line, and your 1 day bump is going to end up costing you 3 to 4 weeks before you get back on schedule. So just be as proactive as you can.
Brenda, thanks so much for your time. We really appreciate it.
Nice seeing you,
Thank you,
Norris.
Brenda.
Bye.
Bye. All right. Well, Scott, you brought up a good point, and along those lines, we have from Marcela Bermudez a question. It says, do you expect to see receivership foreclosure assignments increase as the government supports expire?
Yes. The good news about today versus 2008, 2009 is everything in 2008, 2009 was on credit. There wasn't cash in the system. And today there is so much cash in the system, especially that was raised last year for these opportunistic funds, because everyone thought, oh man, this pandemic is going to create the next 2009, and there's just going to be this significant downturn in values and all these properties, and I'm going to buy notes at discounts, I'm going to buy properties at discounts. And it didn't really happen. The economy and the strength of the lenders and it actually held up pretty well. And so there's billions and billions and billions of dollars out there looking for opportunities. And so even if there is a price decline or there's some softening in the market, there's just so much capital out there that needs to get put to work. I don't see a significant downturn in values, but I do think some of the not as financially strong, some of the owners out there and or lenders that don't have the balance sheet to withstand some stress, there's gonna be opportunities out there for that. And there's people that haven't been paying rent for a year and are still in their places because you can't kick them out. So I think there's going to be evictions. There could be there's a lot of forbearances. We didn't do any forbearances, but and I don't know what Citizens policy was, but I can't tell you how many lenders out there on the more institutional traditional banking side were giving people hey, we'll put a second on and we'll give you 12 months of interest payments. And they were kind of, extend and pretend that there wasn't a problem on some of these assets. So when does that end? When do we start hearing about those deals? If the fundamental property has an issue, it's not getting better. There's some retail stuff out there that is in trouble. There's office stuff out there that's in trouble, hospitality. It'll be interesting. Somebody's going to have to take their medicine eventually on some of these assets. But I think there is ample liquidity out there to gobble this stuff up without having a significant downturn like we saw in 2009.
Daniel, where do you see the pain points?
Yeah, I agree with what Scott's saying. I think fundamentally, our employment base from the credit perspective, we're so much stronger than we were, in 2008 and 2009. So I agree that if there is some foreclosures and maybe some price minor deterioration and maybe market specific, some markets will not have any, deterioration, but I think the supply issue is going to be taken care of because there's so much still fundamental strength in people and their employment situation. So, I think the bigger concern for us relates around inflation and potential, the additional money supply potentially causing increase in interest rates. So, in the past, 10 years, we've had a really low rate environment, and I think we've only seen rates rise in correlation to economic growth. And so it's kind of a good balance. Here now we're potentially faced with a scenario where you could have rates rising due to inflation, not because of the economic growth, and have an offset type of situation. So I think that's what we're worried about, more so than foreclosures. And once again, this gets back to the credit discipline of us, and you're looking at people's experience and their global kind of leverage and cash flow situation. We did, 90 days kind of payment deferrals last year for clients that needed it. But the second 90 days, we didn't just do outright. We had to make sure that, people were still fundamentally strong, that we weren't just kicking a can down the road. And if they were strong and there was a need, absolutely, we work with our customers. But if they weren't and they were, kicking the can, we'd rather realize the situation and deal with it now. So, fortunately, we've had some pretty good success. I think we did about 500 of those kind of deferrals. And I think we have 0 to date.
Wow,
And
that's
so
great.
our customers are reporting that they're collecting, 90% of their rents, which is great. But, I do think retail and office are the areas that, there's still some unknowns about where we're going in that, that area. And so those are the 2 areas where we're watching a little bit closer and a little more carefully than other property types.
that's great. Well, I think let's talk a little bit about what we see in the balance of 2021. We're in the 4th quarter now. And if that really is just more of the same of what we've talked about, I'd love to hear your predictions about 2022. Scott, you want to start?
Well, my crystal ball is, luckily, I don't have to look as far into the future as Daniel and some of the more traditional lenders that have longer term loans that they're putting out. Our average deal is 12 to 15 months. And so we don't have to look as far about where we think the economy is going to be and kind of just the general metrics of the real estate industry. But as I said earlier, I can't remember if it was before we started the webinar or after. I've never been busier in 2 decades on the lending side. The market's crazy, and I don't know if it was pent up demand because people put stuff on hold for 6 to 9 months in 2020, and now they're getting caught up, or it just seems that there's this euphoria in the market, and there's a lot of transactions going on. We are very underhoused in California, and so there's a lot of new housing projects coming on that are affordable. The stuff that we're doing is kind of entry-level housing, and the other thing that's unique about us, and not purely us, but it's very repeat client centric. And so, the clients that we've been doing business with who were in industries that actually did well in COVID, they're busier than ever. The retail stuff that we do is the quick service restaurant, the Starbucks, the 7-Elevens, these types of kind of drive-through and convenience stores that thrived in the pandemic. They're building out more locations, throughout the Western United States than what we've seen in the past. And so we've been very busy on that front. We do a lot of industrial. The industrial market is just on fire. The housing market has been strong. And so, we've got about 55 clients that we do 2 to 3 deals a year with them. And it's just kept us very busy. So, our strategy for next year is if we add another 5 to 10 sponsors that fit our parameters and have the financial strength and have the experience and are developing the product type that we think is going to continue to have strength, then we would love to add them. And if we don't, we'll be okay as well, because the 55 clients, will continue to bring us their new projects. And so, we are looking to partner with the institutional and traditional banks that pay us off once the work is done and they come in and do the takeout loans. We've seen incredible strength on the takeout market in the last 6 months. I mean, where a year ago it was hard to get a takeout loan, today, as Daniel was alluding to, there are so many participants that are back into that market, offering really attractive interest rates and terms. So, if we see risk in a market, we can really get out in like 9 to 12 months and have zero risk in that segment. And so that's kind of how we manage our business is we watch it closely. We're constantly, speaking with bankers, with, obviously you and Toby, what you're seeing out there, the brokers, all the people that are kind of have their finger on the pulse. And when we hear about areas that make us nervous, we usually exit that strategy pretty quickly. And that's the nice thing about doing short-term loans. The tough thing about doing short-term loans is they pay off and you have to redeploy the capital. But that's what we do well. And luckily, due to our repeat client kind of base, we can keep that capital working.
Thank you, Scott. Daniel, what do you see for 2022?
So, we're looking for growth. And so, that is this is a challenging environment to grow in. And so we're having to, almost reinvent how we approach our business and our business model. And so, real estate has become somewhat commoditized. And so for us as a bank, we need to be a little bit more of a full relationship to our clients. And so, what we're looking for people that are experienced, we want them to have staying power. We want them to recognize that we are a partner to them that has staying power as well. So, it's important that they know who they're doing business with, especially when there's so much capital. And I think that's a little different from the last downturn. I think people would take capital from anywhere. And then when they realized at the downturn that bank was going to be quickly selling their note to an unscrupulous investor, I think people want to know that they're dealing with somebody that has strength and stability. And so what we're trying to do is, be more of a full relationship, take a more holistic approach to our customers, not just be a one-off transaction. And so we're looking to, get to know them, spend more time with them. And so that takes a little more efforts to kind of achieve the same results. We think the low rate environment's going to continue. And so when you have that, sort of margin compression out there, the only way to overcome that is either by producing more volume or cutting your expenses. And so, we want to stay stable and move forward. So, it's a challenge, but we're projecting some stability next year in terms of growth. It's just the unknowns about, inflation and cost increases, and whether or not this is really transitory or it's just going to be a prolonged transitory situation. And so, those are challenges we're just going to have to learn to adjust and deal with, but it's not going to change our strategy to grow.
Sure.
Well,
with that's great. Thank you for that, Daniel. With that growth, it also requires some human capital growth and expansion of your team. Daniel, you had mentioned earlier, you've got an open position or two. Why not use the platform to talk about what position you're looking to fill?
Yeah, so I'm looking for a manager for my home lending group. Home lending is a very regulated environment, and so you need somebody who's going to be there every day with daily oversight to make sure we're meeting those regulatory components. But I think the bank as a whole has a significant number of job openings, and so we're looking to get out there to get to know people, build a deeper bench, help people understand our culture so that they can pick the right type of company to come work for. Acquisitions is a part of our growth strategy, and so we're actively acquiring a small bank right now out of Fresno. And so we're going to continue to employ that acquisition strategy to help with the growth. But to your point, it's not just acquiring business. it's actually acquiring the human capital as well, which we sorely need. You know, nobody, I joke with Scott about this, you know, most bankers accidentally become bankers originally. You know, the newer generations are almost purposely not going into banking. So, you know, I think finance as an industry is something where we have to figure out, how do we attract, how do we recruit, how do we develop, you know, the next sort of wave of management. So, you know, those are the challenges we're dealing with, but, you know, we're staying focused and keeping our eyes on the prize here, so.
Yeah, well, that's great. It's great to hear the opportunities out there, and what a great place to work. Scott, how about you?
Absolutely.
How about for Artist
Yeah, I
Council?
mean, we've you alluded to it earlier. We are a new name, but it's been, you know, the same team that's worked together here on the private lending space for the last 5 years, and we had a recent capital raise that, you know, was way higher than our expectations, which has been exciting. We just brought in a $4 billion endowment to do a significant 8-figure investment into the company, and so we're in those same pressures. It's you know, the culture that we build, the character that we're looking for, the integrity, the work ethics, you know, all of those items to join. Today we have 7 employees, including myself, and so to keep that small feel and that, you know, same culture, to bring in new people to that is always a risk. And so we're, you know, actively looking as well. But, you know, we're not of the size of Daniel and Citizens, you know, and trying to manage the capital that comes in along with the team that needs to be there to support it is one of the biggest challenges on the private lending side. But, you know, it's something that we've managed very well over the years, and we know that the team will step up and execute on our vision. But it's, you know, it's hard to find good people out there right now. And I think there's more job opportunities, and there's people that actually want to take those job opportunities and or are qualified to execute on the strategies. So, you know, it's always a challenge, but the private lending industry continues to grow. You know, I think there's going to be some consolidation in the private lending space as well. There's a lot of the big capital guys out there, the BlackRocks, the Blackstones, stuff like that, that are looking to acquire these kind of businesses and roll them up together. So, you know, it's whatever challenges come up, you know, that's why you want to do business with people, you know, like Daniel said, you want to do business with people that are experienced and have financial strength, because, you know, the reason we named our company what we did is we believe that real estate investing and lending is an art. It's not a science. And so you have to be creative. You have to look at every client differently. You have to look at every property differently, and put together a structure that makes sense, and manage all the things that will change. That's the one consistent thing in real estate, is things change. So we're excited for the challenge. You know, we want to continue to grow our platform and be able to continue to help our clients figure out their capital stack for their projects, but protect our investors at the same time. And so it's something that we're excited for, but, you know, it'll be challenging. Sure. as any environment is.
Yep. Well, just to add to the human capital side, because QuickDraw is growing as well. We recently hired a really super smart, energetic, great lady who is a Navy veteran, worked for a small business outside of the military after she was honorably discharged, and she doesn't know, you know, she doesn't have the experience of fund control, but she has all the other boxes are checked. She's smart, she's a go-getter, she's got the technology experience, she's got the attitude and the drive. And so we're taking the organic approach. We can teach you, you know, the fund control business. We can't teach you, you know, the fire in the belly and the desire to learn and to asking questions. So it's very different. There's not a, you know, the good people are working. They're working for our competitors. And
you always hire the person and teach them the skill. You don't hire the skill and try to make them a good person. That will always be a mistake. When you find the right people, you you tie them up, even if you're not ready to hire, and you figure it out.
Yes. Well, gentlemen, we really are grateful to you for your time, for your insight, for your thoughts. Just a wonderful discussion this morning. We also want to thank you for the business, our relationship together, the trust you and confidence you put into QuickDraw. We don't take that lightly at all, and we appreciate every job and have enjoyed and will continue to enjoy working together. So with that, guys, go have a great rest of your morning.
Well, thank you, Greg. I mean, you're critical to our success, and I know Daniel would say the same thing. And all the lenders that you work with, that I know most of them, I know they would say the same thing. Oh, Daniel and I both just went into the dark. But no, appreciate all you do for us, and we exclusively work with you for a reason, because you're the best. So thank you.
Thank you, Scott. Daniel, thank you so much.
That's great. Yeah, thank you for putting this on together. You know, this is challenging times, and so it's important to be able to talk these things out for people to understand what's going on and hear what's going on from our perspective, what we're seeing, and happy to be here and contribute. Thank you for having me.
Appreciate it. Have a great day, gentlemen.
All right, guys. Take care.
Bye.